First and foremost, want to thank the sponsors of the conference and discussions, especially the Austrian Economic Center and the National Women's Republican Club for hosting the event. And also want to give thanks to the former questioners and panelists. I've learned a lot already, so thank you for that. There's really much to discuss. I want to pick up on the theme of this panel in particular, and that is new economic models. And does, quote unquote, does the US adopt better to new challenges than Europe? And I think that the first panel answered a lot of that, and I would agree very much with what Themi said, and that is that the US is becoming more like Europe. So I would answer that question and say no. But then I'd say why? Well, what we're seeing beginning to happen is that in the old days, and I think about things from a financial markets perspective, from the vantage point of the old days, the actions of many would matter for markets. And now what we're seeing is the action of a few matter much, much more. In the old days, economic factors, whether the economy was growing, whether companies were expanding, whether people were consuming more, would really drive market conditions. Today, we're seeing much more from the decisions of a few driving market behavior. In the old days, in the United States, payroll employment would be released, and still is, 8:30 a.m. Eastern Standard Time, first Friday of the month. That would be the king of releases and drive where markets are going. Now, it's more what Janet Yellen is going to say. This is troubling. And you can push this forward into the space of emerging markets. Many emerging markets have historically been driven by politics rather than economics. They're changing. Emerging markets such as Brazil and Poland and even China are being increasingly driven by investment, by companies, by business, and less by what the political elite are saying and doing. So that, I think, is an important change, and it almost picks up, and it does pick up on what John was suggesting, and that is that in the old days, you would have these complex adaptive systems, entities in the economy, whether it was a consumer, whether it was a company, making decisions from the bottom up rather than having them made from the top down. I think that the changes that we've experienced in the last 10 years have been mind-boggling, to say the least. We've had what I would characterize as three never-befores. Never before have we had this expansion of central bank balance sheets and government spending. Let me give you an example. The Federal Reserve's balance sheet went from under $1 trillion to over $4 trillion in a record period of time. What have we gained from that? Certainly, the early stages of those quantitative exercises were helpful at providing liquidity into the country and staving off a protracted recession. Yet with each successive dollop of quantitative easing, we were getting less and less growth. Similarly, we saw advanced economies creating debt in an almost a magical way. For instance, in the United States, we went from a 60% of debt to GDP ratio to over 100% now. We're heading towards 120%. By the way, that's the debt ratio that we had after getting through World War II and getting through a major depression. What do we have to show for that swollen debt burden today? Not much. And in fact, the big swell in the Fed's balance sheet, we've never seen this kind of swell. It took us 6 years to build this balance sheet up. If you look at the biggest chunk of 6-year monetary expansion in this history, we get to half of what the Fed has done in the last 6 years. And by the way, that too was to help fund the World War II effort and getting through a major depression. So That's clearly a never before. We've never experienced this before. The second never before that we've experienced in the financial system is never before have we seen this regulatory overreach. When you look at Dodd-Frank, for example, Dodd-Frank in and of itself is about 3,000 pages. And if you juxtapose those 3,000 pages in Dodd-Frank and you stack next to that the Old Testament, the New Testament, and the Quran, you still don't have as many pages as Dodd-Frank. The regulatory overreach just began with Dodd-Frank and has drifted into rules and regulations that now are in the tens of thousands of pages. Why is this important? It's had a major impact on restricting growth. And I think that when you compare the regulatory overreach coupled with the monetary expansion really has not led to growth in the country. We've had a tremendous impulse of monetary creation, but we've not had a sympathetic pass-through with the financial system. If we actually had the financial system engaging, we'd have much stronger economic activity. The third area, which is also extremely disturbing, is that never before have we had these kinds of distortions in financial markets. Pick a financial market, we can talk about it, whether it's the bond market or the stock market. I'll give you one example. When you look at long-term valuations of the stock market versus the bond market, never before have we seen bond markets this overvalued. Why have they been overvalued? Because the Fed's been buying all the paper. And the Fed's not alone, right? If you look at that expansion in the Fed's balance sheet that we talked about, we can take that same story over to the Bank of England, the European Central Bank, the PBOC, and the Bank of Japan. Bank of Japan thinks they're going to be out of 10-year JGBs by 2020. So a lot of the paper has been repurchased, which is pushing up the value of these instruments. They're massively overvalued. With these incredibly low interest rates, the stock markets become overvalued as well. And when you look at this over a period of time, we have data going back to 1920, never have bonds been this overvalued, and the gap between bonds and stocks have both gone up, but that gap has widened as well. So clearly, decisions are being made in a distorted way based upon these actions. So what do we do about it? I think we need clear and compelling policies to get us back to a period where there was greater harmony in the determination of how decisions were made. Decisions were made by entities operating in this complex economy from the bottom up, that businesses had greater flexibility, there wasn't concern whether there were going to be new regulations. Uncertainty has been a problem. We need to be very clear about the kinds of regulations that we implement. I'm optimistic that we will be making progress in this area. And on the monetary front, which is critical, our center does a lot of work in data. I think we need to be much more data-driven in making decisions that impact the economy and impact people than platitudes. And when you look at the data, when you get deep into the data of what's driving our economy and the financial system, you can see in technicolor fashion that these quantitative exercise did not work, and they failed to live up to the promise that they made to many. So I think now is time to really measure this, move forward with a clear regulatory approach and a clear central bank approach, taking back some of the liquidity that the central banks have provided. We're moving forward in this area, so I too am optimistic that we will make progress in all three of these areas. And then the third, which relates to the markets, will naturally adjust over time back to a better allocation of resources that will be reflected in prices that are greater reflective of valuations. So I'll leave it at that.
Thank you very much.